All right, let's give that a whirl now. Okay, we should be good in the YouTubes. All right, there we go. We should be all set now. All right. Should be all set. So good morning, everybody. Okay, let's get to it. We've got some strength intraday on the S&P, but overall the S&P overnight. So overnight is what? It's the Asian session, it's the European, it's the UK session. And if you take a look at what transpired since about 8 p.m. yesterday, you can see we broke down through support at around 2 a.m. And that would correspond with the European open. So since about Europe, the UK, the Asian close, right? We've seen a lot of weakness there on the ES. And then as we're pouring our first cup of coffee in the US right around 7 a.m., you can see the neutral and then the green candles start to appear on the ES. So that's where we sit right now, 52.82 on the ES. So this is basically when you step back and look at the June 4 candle, it's an inside candle, right? It's not higher than the high from June 3. It's not lower than the low from June 3. We're just stuck in that range there on the ES. And that's not good. It's not bad. It's just pretty much on par for the fact that the ES lost its trend yesterday. We had a little bit of a wobble on the 31st with all that volatility. And so the ES has lost its trend. But please keep in mind that when an uptrend ceases to be, it does not automatically become a downtrend, nor a reason to get bearish, especially if the NAS is still holding its own, if names like Apple and Nvidia can continue to rally. So again, a transition in the trend is far more likely to be bullish, right? It's far more likely to be bullish than it is to be bearish because the trend that is still influential. In other words, look for continuation, not reversals, right? Okay. That being said, that's pretty much what we're seeing. Also, another inside candle today on the NAS, and same overnight action, lower to around 7 a.m. where we're seeing a little bit more strength. And you can see the gap here, and I have a feeling that was where the quotes were acting kind of strangely because I do not believe that was any kind of gap on the NAS in terms of action, just more of, I think, a price quote feed issue. All right, so anytime we have those issues, remember, again, we've been dealing with them on and off, mainly focused around the NYSE, and it's never going to be a reason for traders to get bullish. In fact, when we have these interruptions, which have nothing to do really with the market itself, but more the tech, when we have these interruptions, it tends to trigger some strange selling, just because, again, when we can't see what's happening, people aren't going to get in, they're going to get out. All right. So with that being said, let's jump on over to what's going on with bonds and gold, as well as crude, which continues to be pretty weak. Bonds are moving higher. And this continues to do what? Bonds moving higher in the most basic sense is lower yields. We can talk about the why and the what, but at the end of the day, when we see ZB moving higher or TLT moving higher, ZN moving higher, that's just lower yields. Sorry, and ultimately you might say, Rog, but sorry, are we not going to cut? Don't worry about it. At the end of the day, bond traders are saying, for whatever reason, they're willing to rally ZN, they're willing to rally ZB. And whether this has to do with optimism, whether this has to do with what the Federal Reserve is going to do from a monetary policy standpoint, sometimes it just is what it is. And sometimes it's easy just to, one of the things that one of my mentors used to tell me is sometimes there's a benefit to just imagining yourself a hermit in a cave, and all you do get is price. That's all you can see, your charts, right? Your indicators, your charts, some volume, things like that. And if you back out sort of the noise of the news, and funny how those two words do tend to seem very similar in the way they sound, when you back the news out, when you say, you know what, I'm just going to look at price for price's sake. It's amazing how much clarity you can get. Sometimes things just are what they are, and the why of it just takes you down a rabbit hole. And those are things to keep in mind, especially in a chop. Because what does chop at the end of the day really tell us? In the most basic sense, it's a balance of supply and demand. It's a balance of opinion. There's not more bullishness, there's not more bearishness. People are just pretty content, both on the bearish and bullish side, that this is the value of whatever the symbol is. And gold is a great example of just that kind of balance. We're not seeing a reason for price to break up much higher or break down lower. But the cool thing is, we as traders have other tools at our disposal. And when we don't have a price trend and we don't really have a lot of reason to look for anything but price being stuck in a range, how do we define the range? And one of the ways that I like to do it is I'll look at my price movement ranges, because if nothing else, whether it's a chop or whether it's a trend, barring any news or any kind of external stimulus, price on a particular symbol like gold has a general number of points that it typically likes to move day after day. 68% of the time, price moves within the price movement range. And ultimately, what that tells us is, let's not get too ambitious about price movement above the gold or too bearish below the gray. And we'll just see price movement back and forth. And the more chop we get, one of the best ways to handle that is to shorten the time horizon. Now, day trading in a narrow range or day trading in a range-bound market is a pretty effective way to go, because we don't expect follow through tomorrow and into Thursday and into Friday necessarily until we get a couple of reasons to move beyond this range. So there's two reasons for kind of a range bound. One, price is where it is and everyone's pretty content with that range. Bulls aren't too bullish, bears aren't too bearish. Everyone sort of agrees until there's a reason to make a move. Now, we have two such reasons this week. One reason is JOLTS, which is coming up in 51 minutes. This is the job openings number, which I would say is second only to non-farm in terms of looking at employment, which is the second mandate of the Federal Reserve, looking at employment and looking at the health of employment, right? So that's one hot zone coming up. And then in terms of the next big event, you can take a look at non-farm payroll. So one of the questions that came up is, Juan asks, shouldn't we trade using price decay when in a range? Well, Juan, here's the challenge with that. Because JOLTS is coming up, because non-farm payroll is coming up, that could very well be a catalyst for a breakout. So if you're looking at taking advantage of something like time decay, right? Time decay, you called it price decay, same thing. You're looking for the, on the sell side of the option. You're looking to sell premium. Remember, you probably don't want to do that until after JOLTS, and you don't want to do that going into non-farm. So there is a window perhaps for that if that's something you want to do. I don't like to do that. I would just assume either shorten the time frame and go range to range, zone to zone, or wait for the breakout. Now, underneath all of this is something we want to consider, which is directional bias, right? Directional bias, which means, is there one direction that's a little bit more likely than the other? And in gold, that's a yes. It's more likely that gold will continue to move higher if continuation is really the mantra for the market, and it actually is, right? Markets continue after a pullback far more than they reverse and keep going in the other direction. In other words, V tops and V bottoms are usually rare and also usually only triggered by abrupt shifts in monetary policy or geopolitics, right? None of which we could foresee. So let's just remember that typically continuation is what happens. Now, gold is likely to continue to the upside. NASDAQ is likely to continue to the upside, especially when we see what's going on with Apple and Nvidia. right? So Apple is a position that we have open in the Sector Secrets Mastery. And Qualcomm is as well. We have a position open in RTX as well. So those are some of the positions that we've got in the Mastery that we're managing to the long side as we go into Tuesday's trading session. Okay, so then that brings us to our first question of the morning. Thank you, Eddie. Question on TJX. All right, so let's go up the food chain a little bit. And I always want to know where an individual stock is within the overall groupings of quote unquote the markets, right? So what are the markets? Stocks, sectors, futures, right? So we want to get specific. And this is a stock that's, I believe, 7th, maybe 8th. I'm trying to remember if it's how far down the weighting is, but it's weighted within the consumer discretionary. Now, consumer discretionary has been one of the lesser performing sectors. In fact, when you take a look at the bottom sectors in a performance sort of lineup, right, from top to bottom, strength to weakness, consumer discretionary is down near the bottom relative to everything else, relative to lots of things, basically relative to everything. But I'm trying to think what's down there with it. Oil, energy stocks, regional banks, agribusiness, consumer discretionary, just about everything else in terms of major industries and sectors are outperforming consumer discretionary. Now, that does not mean that TJX may not be able to outperform. In fact, to your point, within consumer discretionary, there are 3 stocks that are a little bit more bullish than the rest. TJ Maxx, Booking, and then I'd have to throw Starbucks in there because it is starting to trigger a little bit of bullish momentum. But as far as trends go, yeah, TJ Maxx is absolutely in a trend. So that means it's valid for buy the dip. Just keep in mind that we want to wait for a dip. That's always going to be my way. And then where to? About 100.8. About 100.8 is where I would look. There's Darvis support there. The 21 top tier propulsion is waiting there. And so there's a lot of reason to expect that right around 100, which is a major psychological level as well, right? That would be a great place if it were to pull back roughly 5.5 points, not even 5.5, because I'm looking at 100.8. So if it was to pull back about $4.40, that's a really great place to buy TJ Maxx. I'm not a breakout trader. That's not my usual way of trading. I don't want to buy at a high, presuming that there are more buyers in line behind me, because really that is what momentum trading is. Momentum trading at its best is when you're at the front of the line at the initial point of the breakout, however it is you measure it. The danger in that is if there is nobody else willing to buy higher than what you just bought at, right? So it does require that you're at the front of the line or near the front of the line. And I think people that are looking at, say, GME, talk about a great example of this in hyperdrive. That's exactly what the game is here, right? Pun intended. The game in GameStop is if there is a momentum breakout, the folks that bought up here, such a great example. Someone who bought at 65, presuming they're at the breakout, they're at the beginning of the higher highs, found out the hard way that they in fact were not. So that's the dark side of momentum, especially if you're very, very, very late to the party. Now you might say, Rog, what about someone who's looking at this below 20 and bought it as it broke out above 20? That would be the best example of momentum. So, I think when we look at something like TJ Maxx, looking for an uptrend to retrace, believing, and I do believe this, that healthy trends correct, which is why buy the dip does work when it's an understanding of healthy trends correcting. And I would say this is a fairly healthy trend, right? So when healthy trends correct, there's your buy the dip. But if we apply buy the dip to a non-trending environment, right, that's where the wheels fall off the wagon. And so that's what I would look at on TJ Maxx, that pullback there. Thanks for the question. All right, next up is Lulu. Sure. Lulu's in a downtrend. Apparently, yoga pants that make your butt look good is not in demand. I don't know what's going on with Lulu. However, I don't need to know much more than the fact that the red candles trading below the mean reversion of the green, yellow, red lines, trading below the white dots of the 200 propulsion, tell me that we're on the bearish side of things. And you might say, well, Rog, it's kind of obvious now. How soon, how quickly could we know that? Really easy. Really easy. I'll show you right now. The way that we would recognize that that's the case is if we go to, let me show you here, right in here. And you can see it actually accompanied earnings. Earnings broke the 200. Earnings started triggering the red candles. And then in the 1 to 2 days after earnings, you'll notice there was no rebound back above that. So at that point, you let earnings simmer down for 1 to 2 sessions. And then you realize, oh, no one's coming in. There's no cavalry. No one's coming in to rally Lulu. No one's seeing this as a sale. Just because something has a low price, right, does not mean that there is demand for the stock, right? Just because something's cheap doesn't mean there's necessarily demand. And so those are things we want to keep in mind when things go red and they break the 200 propulsion and they start pushing lower and lower. So this is the opposite of buy the dip. This is sell the rip. That if price rallies to resistance, right? If price rallies to resistance, that's an opportunity to get long puts. And that's what I would definitely look at with Lulu. Yeah, I don't know what yoga pant technology, right? Maybe they're going to put AI in the pants. I don't know. But barring anything like that, yeah, Lulu looks like it's going to continue to go lower. All right. Next up is a question on XLI. Which index is aligned with industrials? That would be the Dow Industrial Average. I would keep an eye on YM if you're looking at XLI, right? It's not the heaviest weighted sector, but Dow is going to be aligned with XLI, or I should say XLI should be aligned with the Dow. All right. Moving on then to people are running out of money to make, it's funny you say that, Eddie, because, you're not wrong. You're not wrong because look, consumer discretionary really tells you something as opposed to the opposite side of that, which is consumer staples. If I were to, look at what we consider, justifiably discretionary income, a sugar-laden flavored coffee from Starbucks at, I don't know, $9. I'm only slightly mocking Starbucks. Looking at Chipotle, looking at Nike, right? Booking, you would say, okay, these are the things that should do well in a risk appetite, preferably low interest rate environment. Yeah. So yeah, yoga pants, coffee, burritos, travel, McNuggets, Nike, sneakers, right? Air Jordans. Okay, so you think about what's in consumer discretionary. Now, oddly enough, the top 3 names in consumer discretionary are Amazon, which I don't consider consumer discretionary at this point. Amazon really should be in staples. It really should. I mean, if Costco can be in staples, so could Amazon. I don't know about you all, but subscribe and save is a thing around here in my home, right? It's just convenient. Tesla, we could consider to be consumer discretion. That's a number 2 weighted stock in XLY, followed by Home Depot. Again, a quirky trio atop consumer discretionary because someone's designed this ETF to be that way. But regardless, that's where we sit in that group that has TJ Maxx within it. All right. And then Lulu, I would put in the same group, right? Very much a discretionary purchase. Until again, they put an AI, until Nvidia and Lulu get together for some sort of AI yoga pant. I'm only kidding because you know what? At some point, someone might just try to do that. When does Nike start putting some AI chip in the sneaker? They've tried that before. Not AI, but they put chips in sneakers before. And it has to make a comeback. All right. So I know everyone's got their eye. We talked about GameStop. Let's talk about another stock that everyone's talking about, Nvidia. The typical rally, oh my gosh, it's 9:22. Where does the time go? Well, anyways, expect more strength in Nvidia until we get to the split. I don't know that it's going to do a whole lot more than where we are right now at 1150, but I certainly wouldn't short it. Remember, though, traders who own or investors who own Nvidia have to keep it until June 6th to get the 10 for 1. Right after that, look for some profit taking. All right, gang, I got to shut up now. Sorry about that. Ran over. I will see you all tomorrow, same time, same station. Be good to each other, gang.